In this video, we're going to be talking about how do banks create money. And before we delve into that question, we want to remind ourselves that in each country, the central bank is the institution that controls money supply. In the United States, this institution is called, or the central bank is called the Federal Reserve, or the Fed in short. The Fed regulates the banking sector in a way or in an attempt to control money supply. So the Fed, one way it conducts its monetary policy is to ask banks to hold some of the deposits that banks receive as reserves. In other words, let's assume that a lot of people are engaging in the banking sector, and one way that most people engage in the banking sector is by making deposits. So the bank is going to have these deposits, and now the bank can choose to take out or make loans to the public, to businesses, etc., and keep some as reserves. Now the Fed has a role to play in controlling these reserves. So, in other words, the Fed basically asks banks to hold a fraction of deposits as reserves. Okay, so the bank cannot loan everything out. The bank must hold some of these reserves, perhaps for liquidity reasons. Let's say you had $100 and you made that deposit in the bank, and the Federal Reserve told the bank, well, you must store 10% of that deposit as reserves. So which would mean that reserves would be 10% of $100, which is $10. And so the bank is going to be left with $90 to make loans. Okay, so in the event that you go back to the bank, you're not going to be the only one making the deposit. If you go back to the bank is going to have some liquidity in the system where it can give you some money back. Okay, you're not going to need all of your $100 at once, and the bank actually relies on this principle that most people don't require all of their money all of the time, and so they are able to make loans and hold some fraction of deposits as reserves. Okay, so reserves are just deposits that banks have received but have not loaned out yet. Now, the bank can decide whether they want to hold 10%, which is the mandate by the Federal Reserve or the central bank, or they want to hold more as reserves. It really depends on what the bank feels is right at the moment, depending upon the state of the economy or the optimism and pessimism in the economy. So that takes us to the next thing here, which is to talk about the fractional reserve banking system. This is to say that in any country, really, the banking system is held to this type of a mandate where banks keep a fraction of deposits as reserves and use the rest to make loans. Okay, and who is establishing these requirements? It is the Federal Reserve, the Fed, establishes these these reserve requirements. Which is to say that it regulates or it imposes regulations on the minimum. This is important, that the Fed only says, well, you have to hold a minimum amount of reserves against deposits in banks. So banks can hold more than this minimum amount if they choose to do so. The next thing we want to talk about is called the reserve ratio, which is that 10% that I had described in the previous slide. So the reserve ratio is represented by the letter R. R is basically the fraction of deposits that banks hold as reserves. Okay, so this is equal to that, and this is also equal to the total reserves as a percentage of total deposits, which is to say, this is the reserve ratio in the previous example is the $10, which was the bank's reserves, divided by the total deposit, which was $100, right, times 100%, which is just 10%, right? So the reserve ratio in the previous example was 10%. Now we're going to look at a simple accounting statement, a simplified accounting statement that shows a bank's assets and liabilities. This is called a TAccount. It is called a TAccount because it is in the shape of a T. And so this is what it looks like. This is a T. Okay. You're going to have in any balance sheet, this is sort of the bank's balance sheet, a very simplified version of that. So simplified balance sheet. Or accounting statement. Right? And it is going to show you a bank's assets and a bank's liabilities. Right? So on either side, this should add up and be the same number. So if you think about it, when you make a deposit to the bank, that is going to be a bank's liability because it is representing the depositor or your claim on the bank. Okay, so when we're thinking about a bank's balance sheet, this is not your balance sheet, but it is the bank's balance sheet, you are going to have deposits that appear on the liability side. Okay, because the deposits that you make are a bank's liability. So let's say the deposits are $100. Okay, now when you think about the assets of a bank, the loans that a bank makes are its assets because they represent the bank's claims on its borrowers. So loans would appear on the left-hand side or on the asset side. But remember or recall that because of the fractional reserve banking requirement or the reserve ratio requirement, not all of these $100 can be loaned out. And so the banks need to also retain some of those deposits as reserves. So reserves appear on the asset side because they are funds that are available to the bank. And so let's understand a simple example here. Let's say the reserve requirement was 10%, like what we had discussed earlier. Now that $100 in deposits is going to be split between reserves and loans. So reserves are going to be 10% of that $100, which means this is going to be $10. And the rest is going to be available for making loans, which is $90. Okay, so in this example, again, R is basically the reserves, which is $10, divided by total deposits, which is 100. Right, and that's just 10%. I mean, this is times 100, right? So you can multiply this entire thing by 100% to get that number. Okay, this takes us to our next question about how banks create money. And for this, we are going to look at 3 different scenarios. And we're going to roll with that same example of $100 being in circulation. Okay, so in order to see whether banks are able to create money in the system or not, we want to remember that money supply is given by the sum of currency and deposits. This is the definition we're going to use again and again in these 3 cases. Now we're going to look at 3 scenarios. The first one being that there are no banks in the system. What happens then? Do we create money or we don't create money? We want to look at that. And then the second scenario is what happens if we have a 100% reserve banking system, which is to say that the Fed could impose a requirement which requires banks to hold 100% of their deposits as reserves. And so we want to see that scenario and ask ourselves, did the system create money or not? And then the last and final case that we're going to look at is called the fractional reserve banking system, which you're aware of, where the Federal Reserve is only requiring the banks to hold a fraction, not all, but just a fraction of their deposits as reserves. So we're going to look at these 3 scenarios, and let's start with the first scenario, which is what happens if there are no banks in the system. So if we begin with $100, so let's say the public holds $100 in currency, this would just mean that money supply is equal to currency plus deposits, right? Nobody has made a deposit, and so this is equal to 0, but this is equal to $100, right? And so the total money in the system, we started with $100 and we end up with $100. So no money was created. Let's look at the second scenario where you have a requirement which says 100% of the deposits must be held as reserves. So in this system, if the public, because this is a bank, if the public deposits the $100, this is in deposits. Okay, so $100 is deposited in the bank. So $100 would appear on the liability side in the T account of the bank. Then 100% have to be of those deposits have to be held as reserves. So what do we have to loan out now? Nothing. We don't get any money that's available to be loaned out. So again, we can look at, in this scenario, what is going on with total money supply, which is equal to currency plus deposits. So money equals currency. Well, no one is holding currency because they made a deposit, so this is going to be 0. This is 0. Plus deposits are $100. Okay, and so money supply, which implies money supply, equals 100. And so in this case, also in a 100% reserve banking system, banks do not create money supply. Banks do not create money. We started with $100, we end up with $100. Now the third scenario is called the fractional reserve banking system, in which the reserve requirement, we can roll with one example, which is what you're familiar with now. If the reserve ratio is 10%, then this is saying that the Fed requires the banks to hold 10% of their deposits as reserves. So if deposits are $100, reserves are going to be $10, and then the rest can be used to make loans, which is $90. Okay, so in this case, depositors have $100 in deposits. Okay, this could be their checking account, for instance, and borrowers. Right now, this borrowers, that is to say that anybody who took out a loan from this bank, which is Bank A, now has $90 in currency. So borrowers have $90 in currency. So there's sort of a cycle that you can see here. That now if we look at money supply and its definition, we can say that, well, deposits, the initial deposit was $100. Okay, that's still there. And now, because someone else got that $90, currency is $90. And so the money supply is 190. Okay, in the system. So this might be an awkward idea here, because you're thinking that, well, we only started with $100. Have we generated or have we created any wealth? The answer is no. We haven't created any wealth. Banks don't create wealth, but they create money. And this is really because we define money as being the sum of currency plus deposits. Okay, so to illustrate this point further, we can see what that person is going to do with that $90. So let's say the person who received the $90, because they took out a loan, now deposits that $90 in their bank. Okay, and let's call that Bank B. And so if R, which is the reserve ratio, is still 10%, that $90 right here can be split again into reserves and loans. And so 10% of $90, which is $9, would appear as reserves for Bank B, and it would be left with $81 to loan out to someone else. Okay, and you can imagine that this person who's taking out a loan from Bank B can now go to Bank C and make a deposit of $81. And again, we have the same cycle where $81 can be split into $8.10, which is 10% of 81, and $72.90 left to be loaned out. Okay, so you see the cycle where we started with $100, and then we had 90 to be loaned out, and that loan was now a deposit for someone else, and that $90 split again into $9.81, and that $81 becomes a deposit for a third person. And this chain continues. So the process would continue. We had an initial deposit of $100, and then the bank, when the first bank, Bank A, was lending, that became $90, which became the deposit for the second person, which became $81, $72.90, and so on and so forth. So you see that the numbers are decreasing, right, as this process continues. And so the question is, well, what would happen? How much money would be generated in each step? Because these are just deposits one after the other. We started with a $100 deposit, and then all of these next steps are just adding value to the currency in our definition of money supply equals currency plus deposits. So in this example, $100 creates $1,000. So that $100 of the initial deposit creates $1,000 in money. Now you might say, well, why? How did you get to that $1,000? The answer is using a formula called the money multiplier. So the money multiplier is basically the amount of money or it tells us the amount of money in that the banking system generates with each dollar of reserves. So the formula for money multiplier equals 1 over the reserve ratio, which is R. Okay, so if we think about our example, in our example, R was 10%. Okay, so the money multiplier is going to be equal to 1 over R, which is 1 over 10%. Okay, you can write this as, if you want to switch out the percent sign, that's just 1 over 100. So 100 would come to the denominator, and this would be divided by 10. So the money multiplier is 10, which is to say that if we started with $100 in reserves, we would generate 10 times the amount of money. So $100 in reserves would generate $1,000 in money. And that is the idea of the money multiplier.